Welcome to Fundamental Deep Dive. I'm Alex.
And I'm Ivy.
Today, we're heading north. We're looking at the Canadian energy patch and specifically at a company that just dropped a massive data dump.
The huge one.
It is Friday, February 6th, 2026. The company is ARC Resources, and they have just released their fourth quarter and, of course, their full year 2025 results.
And, usually these earnings reports can be pretty standard fare. You get some revenue numbers, a little bit of production data.
A polite nod to the shareholder.
Exactly, and everyone goes home. But this is a beast. There's a real story here.
A beast is right. I mean, we are looking at record-breaking production, a billion-dollar acquisition that's now fully online, and a cash flow machine that is, frankly, it's startling.
It is.
But, and there's a big but buried in this report, there is a very specific, I'd say very strategic hiccup happening in one of their crown jewel assets.
And that's the narrative arc today, isn't it? On the surface, it looks like a complete victory lap. They are the largest they have ever been in their entire 30-year history.
Right.
But when you peel back the layers, which is exactly what we're going to do, you see some really complex and I think really smart decision-making happening.
How's that?
It's a masterclass in how a top-tier operator handles it when things don't go according to plan in one specific area, while everything else is just firing on all cylinders.
Exactly. It's this weird mix of everything is amazing and hang on, we need to fix this one thing immediately.
Okay.
So before we get lost in the millions of barrels and billions of dollars, let's do a quick level set.
Good idea.
For the listener who maybe doesn't have a ticker tape running in their brain 24/7, who is ARC Resources?
ARC is what we call a pure-play Montney producer. Now, if you're not a geologist, the Montney is basically the premier natural gas and condensate formation in Canada.
So kind of like the Permian Basin in Texas, but for Canada.
That's the perfect analogy. It is world-class rock. And when we say pure play, it means they don't dabble.
They're not in the oil sands. They're not doing offshore drilling.
Exactly. They do one thing, the Montney, and they try to do it better than anyone else, and they've been around for 30 years. This is not a startup. They're an institution.
So what's their reputation built on?
It's really built on three things: strict capital discipline, a fortress balance sheet, and returning a lot of cash to shareholders. That's their playbook.
And for anyone who wants the full history lesson, the geology, the 30-year backstory, we actually did a full breakdown of their asset base in a previous deep dive.
That's right.
For a full breakdown of ARC Resources, check out our previous deep dive on the channel. Today, we are strictly looking at the here and now.
And the here and now is massive.
Okay, let's get into those headline numbers. This is what jumped out at me right away. I looked at the production figure for Q4 and I honestly thought it was a typo.
It's a staggering number. It really is.
Q4 production averaged a record 408,382 BOE per day. BOE, for those new to this, stands for barrels of oil equivalent. I mean, over 400,000.
Yeah.
To put that in context, where does that actually sit in the hierarchy of Canadian producers?
Oh, that puts them firmly in the heavyweight class. We are talking about a scale that very, very few companies in Canada can achieve outside of the major oil sands players.
But you always say volume is vanity.
And profit is sanity. It always is. What matters here isn't just that they produced 408,000 barrels, it's what those barrels were.
The flavor of the barrel, so to speak.
Precisely. If that was all dry natural gas with prices where they've been, we would not be having this conversation.
We've been talking about a company burning cash?
We would. But the mix was 58% natural gas and 42% crude oil and liquids.
And that 42% is the magic number.
That is the moneymaker. Liquid commodities, crude oil, condensate, NGLs, they trade at a massive premium to gas. And specifically, their crude oil and condensate production hit 118,898 barrels per day.
Wow.
That is the highest number in the company's entire 30-year history.
Okay, I want to pause on that. 118,000 barrels of liquids a day. That's just an incredible amount of cash flow. And looking at the year-over-year stats, production per share increased by 10% compared to Q4 2024.
And that per share metric is so vital. It's so important. Companies can grow by just issuing a ton of new stock to buy other companies, which dilutes you, the owner.
Right. It's like cutting a pizza into more and more slices. You aren't getting more pizza.
Exactly. But ARC grew production by 10% per share. That means your slice of the pie actually got bigger and more valuable.
So the operational engine is just humming. Let's look at the bank account. What did all this production translate to in actual dollars?
It translated to a very, very healthy war chest, Funds from operations, or FFO, came in at $874 million for the fourth quarter alone.
$874 million in 3 months.
Yep, that's $1.1052 per share. For the full year of 2025, they generated $3.2 billion.
$3.2 billion. That is serious walking around money. But FFO is just the cash coming in the door, right? That's before they have to pay the bills to drill the next well?
Correct. FFO is the gross cash flow. It's the money the business generates from selling its product before any reinvestment. The number savvy investors really care about is free funds flow. That's the cash left over after they have paid all the capital expenditures, all the drilling, the fracking, the pipelines, all the maintenance. This is the distributable cash.
The money they can actually give to us, the shareholders, or use to pay down debt.
Exactly. And in Q4, despite having a very heavy investment program, they generated $415 million in free funds flow. For the full year, $1.3 billion.
So just to be clear, they paid for all their growth, they maintained all their existing assets, and they still had $1.3 billion left over in the checking account at the end of the year.
That is the definition of a healthy resource company. They aren't scrambling to borrow money to drill. They are self-funding everything and generating a massive surplus. This is what you want to see. It's not just about can we grow, it's can we grow and get rich doing it.
Okay, so we've got record production, we have record liquids, but this didn't just happen by magic. You don't just wake up one morning and find an extra, 40,000 barrels in the ground.
Oh, no, you do not.
This surge has a very specific origin story.
It does. You can't squeeze that kind of growth out of old rocks without some kind of catalyst. And this brings us to the growth engine, the Kakwa acquisition.
Right. This was the big news back in, July 2025. They bought a huge package of assets in the Kakwa area from Strathcona Resources.
It was a $1.6 billion deal. And at the time, there were some questions. Was it too expensive? Would it integrate well with their existing operations?
Large acquisitions are notoriously difficult to pull off without hiccups, right?
Absolutely. I mean, you're taking over someone else's wells, their infrastructure, sometimes their problems. But now that we have the Q4 results, the first full quarter of integration, we have the answer.
And the data seems to say, yes, it was a good deal.
A resounding yes. In the fourth quarter, that Kakwa asset alone averaged 215,073 BOE per day.
Wait, hold on. Let me do the math there. Total production was about 408,000. Kakwa was 215,000. That's more than half the company's entire production coming from this one new area.
It is the heavyweight champion of their portfolio now, no question. But it's not just about the bulk, the sheer volume. It's about that specific high-value liquid we keep mentioning, condensate.
Okay, we need to do and explain like I'm 5 on this.
Yeah.
Why is everyone in the Canadian energy patch so obsessed with condensate? Why is it sometimes worth more than regular crude oil?
It's a great question. It all comes down to viscosity. So Canada produces a lot of bitumen, the really heavy stuff from the oil sands.
It's like molasses or tar.
It is. It won't flow through a pipeline at room temperature. To move it to market, you have to dilute it to make it flow. And condensate is this ultralight, almost gasoline-like oil that acts as the perfect diluent.
So the oil sands guys need this stuff to do business. They literally cannot export their primary product without it.
Desperately. Canada is chronically short on condensate. We usually have to import it from the U.S. through pipelines just to blend it with our own oil so we can send it back out.
That's crazy.
It is. So if you can produce condensate domestically in Canada, you get a premium price for it. It often trades higher than WTI crude because of that local scarcity premium.
So buying Kakwa wasn't just about getting more barrels. It was about getting the right kind of barrels.
That was the entire strategy. Kakwa produced 124,505 barrels per day of condensate and NGLs. That acquisition was a strategic pivot to get oilier and capture that premium pricing. It transformed their production profile almost overnight.
So they went from being a gas-weighted company that had some liquids to a liquids powerhouse that also happens to produce a lot of gas.
You've got it. That's the transformation.
It sounds like the perfect deal. They bought it, they plugged it in, and it's just printing money. It justifies that $1.6 billion price tag pretty quickly.
It does, but...
There it is. The but.
There is always a but in these reports.
Okay, let's talk about it. Section 4, the Attache speed bump. Because while Kakwa's having this huge party, something interesting and maybe a little concerning is happening over their other major asset, Attache.
This is the part of the report that requires critical reading. If you just skim the headlines and the big numbers, you completely miss it. But if you're a serious investor, this is the section you circle in red pen.
And Attache has been the golden child for a while, hasn't it? They've been hyping this up as the next big growth wedge for the company.
Absolutely. It's a massive land base, over 360 net sections of land. For years, the whole narrative has been, after Kakwa comes Attache. It was supposed to be the next major phase of development, another condensate-rich jewel.
Okay.
So they brought some new pads on stream late in 2025 and into early 2026, targeting the Upper Montney Formation.
And then we get this operations update section. There's a phrase in there that just jumped off the page at me. Variable and below expectations.
In the world of corporate communications, that is a flashing red light.
Variable. That's a very polite, very corporate way of saying some of these wells are duds.
Or at least, we thought we'd get X and we got significantly less than X. It likely means the flow rates aren't sustaining, or maybe the water cut is higher than they expected, or the pressure's dropping too fast. Something's not right.
So what happened? Did they just miss the rock? Did they frack it wrong? What does that mean?
Well, the report mentions they need to refine well design and apply operational learnings.
Reading between the lines.
Reading between the lines. The Montney is incredibly complex. It's a siltstone, not a simple shale. It has different layers, upper, middle, lower. And sometimes the recipe that works perfectly in one area, the spacing between the wells, the intensity of the fracking fluid, exactly where you land the drill bit within a 10-meter window, it doesn't translate perfectly 5 miles down the road.
It's like baking. You can have the same ingredients, but if your oven is just 10 degrees cooler, the whole cake falls.
That's a great analogy. And it seems that Attache, on these early pads, the cake fell a little bit. Now, here is the crucial moment. A desperate management team would just keep drilling. They'd try to force the volume to hit their targets, just hoping the next well is better.
Drill, baby, drill.
Yeah.
Just mask the problem with more volume. Churn through capital just to keep the headline production number looking good.
Exactly. And that is how you destroy shareholder capital. You spend millions and millions drilling holes that don't pay back. ARC did the opposite. They announced they are removing asset-level production guidance for Attache for 2026.
They just pulled the guidance.
Yeah.
That seems pretty drastic. Usually companies will lower guidance or try to fudge it, but to remove it entirely for that asset.
It's honest, and I think it's strategic. They are hitting the pause button on the whole ramp up to study the data. They are basically saying, we are not going to spend hundreds of millions of dollars drilling subpar wells just to hit a number.
They're going back to the lab.
They are. They need to figure out if they need to change the proppant loading or the well spacing or the landing zone.
So is this a disaster for the stock?
I don't think so. In fact, I would argue it's a bullish signal for the management culture. Look at the corporate guidance. Despite pausing their next big thing, the overall corporate guidance for 2026 remains completely unchanged.
Wait, how is that even possible? If your main growth engine stalls, shouldn't the whole car slow down?
That is the power of having a diversified portfolio and the sheer strength of that Kakwa asset. The rest of their business is performing so well overperforming, really, that they can absorb a delay at Attache without missing a single corporate target.
So Kakwa is effectively carrying the whole team right now.
It is. It's a massive flex. It's like saying, we broke our shiny new toy, but we're so rich from our other toys that it doesn't even matter for this year.
Wow.
They are betting that the market will reward them for this discipline rather than punishing them for the delay. They're preserving the inventory. Those barrels are still in the ground. They aren't going anywhere. They'll just get them later when they figure out the right recipe to get them out profitably.
Discipline over ego. I like that. It reminds me of that saying, if you find yourself in a hole, the first thing to do is stop digging.
Exactly. And ARC just put down the shovel at Attache to look at the map again.
Speaking of discipline, let's look at how they sell their product. Natural gas marketing. This is an area where Canadian producers, they usually get crushed.
Oh, the AECO price. For any of our international listeners, AECO is the benchmark price for natural gas in Western Canada, and it is notoriously volatile. It often trades for pennies.
Why is that? What's the fundamental problem?
It's a bottleneck issue, pure and simple. Western Canada produces way more gas than it consumes locally, but there are only so many pipelines to get it out to other markets.
So when demand is low in the summer, or if a pipeline goes down for maintenance,
The gas gets trapped in Alberta, there's a glut, and the price just crashes. There have been days where producers literally have to pay someone to take their gas.
and in Q4, the AECO market was terrible, right? Warm weather, high inventory.
It was a bloodbath for anyone who was fully exposed to that local price.
But when I look at ARC's realized price, the price they actually got paid, it says $3.77 per McPhef.
Which is astounding in that environment.
The report says that is a $1.43 premium over the AECO index. That's 61% higher. How? I mean, are they selling some kind of magic gas?
They are selling traveled gas. This is ARC's superpower, market diversification. Years and years ago, they made expensive long-term commitments to reserve space on the big pipelines that go to the U.S.
Where'd they go?
They go to the U.S. Midwest, the Pacific Northwest, even down to California. So while everyone else is fighting to sell their gas at the local hub in Alberta for, say, $1.
ARC is shipping theirs to Chicago or Seattle, where the prices are maybe $3 or $4.
Precisely. They are bypassing the local bottleneck. It's the difference between selling your apples at the orchard where they're rotting on the ground versus paying to truck them to a Whole Foods in the city. You pay for the truck, that's the pipeline toll, but the price difference is massive.
And that takes a lot of foresight, doesn't it? You have to sign those pipeline contracts years in advance.
You do. And you have to pay for that capacity whether you use it or not. It's like an insurance policy. But in quarters like this, where the local price just completely collapses, that insurance policy pays out massively.
And speaking of that, there was another interesting note about their Sunrise asset. They actually curtailed production. They shut it in.
This is another perfect example of that value over volume philosophy. At Sunrise, which is a dry gas asset, meaning it doesn't have that valuable condensate.
So it's more exposed to those low local prices.
Exactly. The local prices were just too low in Q3 and Q4. So ARC looked at the numbers and shut in approximately 12,000 BOE per day.
They just turned the valve off.
They did, about 70 million cubic feet a day. They looked at the market and said, if you aren't going to pay us what this is worth, we are simply not going to sell it to you.
That takes guts. Most companies are obsessed with their production growth graphs going up and to the right. Shutting in production makes the graph go down. Analysts hate that.
They do. But it makes the profitability go up. By shutting it in, they deferred $50 million in capital expenditures. They didn't burn cash to produce a product that wasn't making any money. They treated the reservoir like a savings account.
I'll just leave the money in the bank till the interest rates go up.
That's the perfect way to think about it. The gas isn't perishable. It sits in the rock under high pressure. When prices recover, say, in the winter, or when new LNG export capacity comes online, they can turn the tap back on and sell it for a real profit. It sounds simple, but you would be shocked at how few energy companies actually do this.
Really?
Oh, yeah. There is a produce-at-all-costs mentality baked into the industry that ARC seems to be completely immune to.
Okay, so let's recap the strategy so far. They're making a ton of money from Kakwa's high-value liquids. They're saving money by pausing Attache to fix the engineering. They are maximizing value by shipping gas to the U.S. and shutting in cheap gas at Sunrise. The big question is, where is all that cash going? Section 6, shareholder returns.
This is the show me the money section. And boy, did they show us the money in 2025. ARC distributed 75% of their free funds flow back to shareholders.
75%.
That totaled $966 million.
Nearly $1 billion back to the owners in one single year. That is not chump change.
Not at all. And they used two main levers to do it. First, the dividend. They hiked it by 11%. That is the fifth consecutive year of increases. It's now sitting at $0.84 per share annually.
Which is a nice steady yield, but the real heavy lifting was the buybacks, wasn't it?
The NCIB, the normal course issuer bid, in 2025, they bought back 19.7 million shares. But Alex, look at the longer trend mentioned in the report. Since September 2021, when they started this aggressive buyback program, how much of the company have they actually bought back?
It says 22%.
Think about that for a second. 22%. Almost a quarter of the entire company is gone, just vaporized.
So I bought shares back in 2021 and I just sat on my hands and did nothing. My ownership stake in the business has automatically increased by over 20% just because they shrank the entire pie.
That's it. Imagine a pizza cut into 10 slices. You own one slice. The company buys back 2 of the other slices and throws them away. Now, there are only 8 slices, but the pizza is the exact same size. Your one slice is now a much larger percentage of the whole thing.
And every time they buy back a share, the dividend payments that would have gone to that now non-existent share are saved.
Exactly. It makes the remaining dividends safer and easier to grow in the future. It's a flywheel of value creation. As the share count drops, the free funds flow per share just goes up and up, even if the total company stays flat.
And they aren't stopping. What's the promise they are making for 2026?
The guidance is bold. I mean, really bold. ARC intends to distribute essentially all free funds flow to shareholders in 2026.
Essentially all.
Yeah.
Not 50%, not 75%, all of it.
All of it. If we look at their own forecast, they expect to generate about $1.2 billion in free funds flow next year. That is a massive wave of capital coming back to investors. They're basically saying, we have paid for our operations, we have paid for our capital program, and we don't need to hoard this cash on the balance sheet.
They can only do that because the balance sheet is so pristine, right? They aren't worried about having to pay down a bunch of debt.
No, not at all. Their net debt is $2.9 billion. That sounds like a big number, but in this industry, everything is relative to cash flow. That debt is only 0.9 times their funds from operations.
So less than 1 times leverage. That is incredibly safe.
It is. Their internal ceiling, the danger zone they try to avoid, is 1.5x. They are way, way below that. They have an investment-grade credit rating. They are financially bulletproof. So they literally don't have a better use for the cash than to just give it back to us.
They aren't going to go out and do a stupid acquisition just to get bigger.
Exactly. They're giving the money back so the shareholders can decide what to do with it.
Which brings us to the valuation. If they're buying back this much stock, they must think it's cheap. Do the reserves actually back that up?
They do. Section 7 covers the reserves report. This is the annual independent audit of what they actually have in the ground. They replaced 121% of what they produced last year.
So the tank is fuller today than it was a year ago, even after producing all that energy.
That's right. The inventory grew. And the value of that tank, the net present value, or NPV, of their 2P reserves, that's proved plus probable, discounted at 10%, came in at $38.71 per share.
And the stock has been trading in the mid-$20, around $25, $26.
Right. So the official engineering report, which is audited by independent third parties, says the assets in the ground are worth nearly $39 a share. The market is selling those same assets for $25. That gap is precisely why they are buying back stock with both hands.
If you can buy $1 for 65 cents, you do it all day long.
Until the market corrects that discrepancy, that is the single best investment they can make. Better than drilling new wells, better than buying other companies, just buying their own undervalued assets.
And we should probably mention the reserve life index.
Yes, 15.1 years for 2P reserves. That's the runway. It means if they stopped all exploration today, they could keep producing at this current record rate for 15 years. That provides a lot of stability. It tells you this isn't a flash-in-the-pan business. They have a long, long runway.
Before we wrap up, there are a couple of smaller corporate updates in the report. We saw a mention of Cedar LNG.
Just a brief update, but it's significant for the long game. They have a firm agreement with an ExxonMobil affiliate to start selling liquefied natural gas, or LNG, starting in late 2028.
And why does that matter so much?
This is the next evolution of that marketing strategy we talked about. It's about getting their gas off the North American continent entirely and into global markets, because gas prices in Asia or Europe can be double, triple, sometimes 5 times what they are here. If they can get their molecules onto a ship, the profit margin just explodes. It's a long-term play, but it's moving forward.
Got it. And a new board member was appointed, Jonathan Wright,
the former CEO of Nuvista Energy. And Nuvista is another big, respected Montney player. This is a very smart pick. He knows the rock, he knows the region, he knows the pure play model. It reinforces that board-level expertise. It shows they want people in the room who understand the specific geological challenges we just talked about with Attache.
A very strategic addition. All right, let's bring it all together with Section 8, the 2026 guidance and our final thoughts. What does the next year look like for ARC?
It looks steady. Production guidance is 405,000 to 420,000 BOE per day. That's basically flat to slightly up from the Q4 record we just saw.
A consolidation year, it sounds like.
Exactly. They are digesting the massive Kakwa acquisition and taking the time to fix the recipe at Attache. CapEx is planned at $1.8 to $1.9 billion. And importantly, they are basing their budget math on $59 WTI oil.
Which is very conservative.
Very conservative. If oil is 70 years, $75, that free cash flow number goes through the roof. But even at $59, they still generate that $1.2 billion in free cash. They're building a budget that works even if the world gets messy.
So, to synthesize this whole thing, we have a company that just posted a record year, fueled by a successful, massive acquisition in Kakwa. They have a hiccup at Attache, but they are handling it with discipline rather than panic.
Yeah.
And they're promising to empty the entire piggy bank into shareholders' pockets in 2026.
That's the summary. ARC Resources is proving why it's considered a premium operator. You know, anyone can look like a genius when oil is at $100 and every single well is a gusher. The true test of a management team is how they handle the variables.
The Attache test, as you called it.
Exactly. And I think the provocative thought for you, for our listeners, is this. Is it better for a company to hit every single target at any cost, maybe blinding themselves to efficiency just to please the market in the short term? Or is it better to publicly pull back guidance the moment the data looks variable?
You're suggesting the bad news about Attache is actually good news about their corporate culture.
I am. I think ARC is betting that admitting a short-term issue to ensure long-term profitability is the move of a winner. They are sacrificing vanity metrics for real, tangible value. And given their 30-year track record, I'm inclined to believe they will figure Attache out. In the meantime, the cash flow from Kakwa is more than enough to pay us to wait.
It's a compelling thesis. Discipline over drama. Well, that's ARC Resources for you. A fascinating look under the hood of a Canadian energy giant.
It certainly is. A lot to unpack.
Thanks for watching and subscribe if you found this podcast helpful.